Credit spreads at 20-year lows. Global debt tops 320 trillion, 40% maturing in 3 years. Private credit, a 3 trillion market paying double-digit yield with hidden risks. Is this the next credit crisis or just another wall of worry? Welcome back to Navellier Market Buzz. Joining us is Mike Lanier, founder of Dial Capital Management with over 40 years of experience. Thank you so much, Mike, for being here.
My pleasure.
I'm excited to have Mike. A little history of my relationship with Mike. After the 2008 financial crisis in early 2009, I was doing stock UITs with a firm called Advisors Asset Management based in Princeton. And I thought it was a good time to do bond UITs because bond yields had spiked after 2008, and we expected yields to be collapsing. And what happened is Mike was able to buy bonds that a lot of financial advisors couldn't find on their own. These are what we call triple B bonds, investment grade, although he is a high yield specialist. And we went on and raised over $2 billion. I think we had over 140 UITs. And the reason they sold so well is when you buy a bond mutual fund or a bond ETF, there are two risks. One is called the duration risk, which is how far out in the yield curve they are and how volatile they could be. But a hidden risk you don't often see is called transaction risk. That's the spreads associated with buying and selling bonds. And what happened is by doing these bonds in a UIT, we eliminated the transaction risk. So anytime there's a run on ETF assets or mutual fund assets and bond products, that transaction risk can show up in an ugly way. Mike, could you explain to people how there is no bond exchange, how bonds are still traded over the counter and still have spreads?
Yeah, there are really no market makers in the corporate bond arena. The banks underwrite the new issues, they bid for them until they're placed, and then it's primarily a buy side to buy side transaction, and there's no tape. You don't really hear for sure where these things are trading. And you get surprised when you want to get out, or you end up paying more than you expected when you try to add to a position. So it's something that a person that trades stocks on their Fidelity account would not be familiar with.
And to get a good spread on a bond, you got to buy at least $1 million worth, right?
Yeah, the institutions, they'll do quarter millions at the smallest, and they prefer to do $5 million blocks.
Okay, there you go. So Mike, we're showing a chart of the iShares 20 plus year ETF, how it's dropped 48.7%, and it's obviously not making people money because yields have been erratic, and but we're also showing a chart of the 10-year, how it looks like it's about to tip and start to decline. So one of the reasons we wanted to have you on is I'm of the opinion that there is a global interest rate collapse underway. Obviously, we got evidence this week. We're going to have multiple Fed officials calling for a rate cut in September, and probably some more later in the year. And so I just think now is a very good time for people are going to buy bonds to buy them, and because they can make a lot of money as yields plummet. So I guess the question is, should they do treasuries? Should they do corporates? Do you have any opinion on what the best place they should be and the duration?
Well, the issue with your forecast for falling interest rates, is it because you think the world economy is slowing, or because you think inflation is going to go down significantly?
I think it's the collapse of household formation for the entire world except for the U.S. and India. I think Brazil had some household formation, but that's about to stop. So you know, it's hard to grow your economy when you have fewer people. And Asia has incredible demographic decline. Japan is the highest birth rate of anybody in Asia, but obviously not enough to replace households. An economy can, continue their growth with orderly immigration, but that's not common in Asia, and obviously in Europe, outside of maybe Spain and Portugal, immigration is a very contentious subject because they're not assimilating people. Here in the United States, of course, not only do we have household formation, because we have pro-family areas in the South and the Mountain West, and well, even where you are in Houston, my daughter lives in the university area, my oldest daughter, and they were made very clear that if they want their child to be in one of their schools, they're supposed to show up on church night, which is Wednesday night. So even you're in a very pro-family area, and then of course you're in a huge city that's a melting pot where immigrants are welcome and they grow and prosper, and of course Trump wants them to have green cards, but I just think the U.S. is better positioned. Plus, our states compete with each other. You see that with Texas being one of the big winners. So no, it's mostly demographics, and also I just think the U.S. has a better model. So I think we'll be the oasis, but I don't know how you grow an economy when you're losing people. I realize you can have productivity gains, but that's my main thesis.
Well, I agree with everything you just said. I think it's difficult to expect inflation to drop to 2% or less. So, what would take rates down is a slowdown in global growth, which you just described. But there's also another consideration of why the U.S. is a better place to invest in the debt market. Is we have by far the most advanced corporate bond market. Most of the rest of the world, the banks are the primary lenders. Europe has a reasonable corporate bond market. Asia has virtually none. And part of the reason for that is that our bankruptcy laws are so much more efficient. If you file bankruptcy in Asia, the equity holders have 5 years to come up with a plan, and the bondholders don't get paid the whole time. So that's why they can't develop a bond market. Recently in the United States, when a company gets into trouble, 2/3 of the time they do a debt exchange within less than a year, and you move on, and you can evaluate what your recovery is likely to be. It's just something that doesn't exist, and it's a real strength of the American capital markets. So, if you think global rates are coming down for the reasons you described, I would stay in. Sovereign debt's going to work because sovereign debt has a real difficulty defaulting. But if you're going to do corporate debt, your choices are really the U.S. or Europe, and even Europe's rules for workouts aren't as good as aren't as quick or clear as the United States. So I would stay in the U.S. if you're not going to do sovereigns. I would have a bias towards the quality of the investment grade. High yield takes credit analysis skills that I don't think most retail people can muster. So, yeah, and if I can pretty much guarantee you, if you're right, and there's a slowdown, a clear slowdown, high yield will cheapen up pretty rapidly.
This is a good time to remind everybody that we did all those UITs for AAM, and there's still some outstanding. And Advisors Asset Management has been sold, so we're not actively doing anymore. Um, but you didn't have any defaults, and you bought a lot of different bonds that several-year run we had. So
The timing was good. When the Fed came in and injected all that liquidity during COVID, defaults almost vanished. There was so much cash.
well, this another interesting thing is when rates come down, don't a lot of companies want to refinance their bonds? So aren't a lot of them callable, so they'll never hit maturity?
There was a massive amount of refinancing when people were making 3% mortgage rates. Corporations were not only refinancing to lower coupons, they were buying as long bonds as they could get placed in the market. So, but once again, that is the difference between a company that can access the bond market and these smaller credits that can only do bank loans. Um, and it's interesting that the default rate overall in the U.S. is higher than the high yield default rate because there's so many small mom and pop bank, that are bank financed, and they run out, they run out of money, and the high yield market can sell you 10-year bonds, and the bank loans are 5 years at the best, often 3 year, and so you get your feet put to the fire very rapidly if you're a bank loan only borrower.
You're in the oil patch. I think your Exxon's near you. There was a cutoff in credit for a while to the oil industry because they were kind of shamed by all the ESG people and all that stuff. And obviously, President Trump's back making the banks lend to people, at least that vote for him. So is credit alive and well now for the oil patch?
Yeah, they're doing. They haven't had. It's a case of the bigger. I mean, the drilling rates haven't exploded like Trump has wanted them to, but the larger companies still generate a tremendous amount of cash flow. But they've certainly been an underperformer in the stock market.
Mm-hmm.
Though the demand for energy, we've seen utilities be one of the better sectors thanks to these massive data centers that are going to tax the grid. And so, energy demand is increasing.
Yeah, the growth seems to be mostly natural gas, LNG, midstream pipeline. Yeah, it's going to be interesting to see how all this unfolds.
So today's tight spreads hide weakness in smaller firms without bond access. But why are spreads so low when debt risks are so high?
Well, it's a case of the haves and the have-nots. There's been relatively low default rates in companies large enough to access the bond market. And philosophically, default rates should be the number one determinant on spreads. The strong equity markets bring confidence that the equity cushion on the balance sheet that protects the bond valuations is a comfort as well. I mean, we have record stock markets. And sovereign yields are generally low. I know they're coming down and we expect them to keep falling, but historically speaking, they're pretty low, and investors are seeking yield. And so if they can pick up 1 or 2% more in a debt instrument, many retail investors find that attractive and meaningful. And there is a great deal of cash sloshing around in this market. The money market balances are still a couple trillion or something. And people want to feel like they need to put that to work. And now I think with the Fed almost for sure cutting in September, looks very likely they'll cut twice by year end. That 4% you've been getting in your money market is going to go away, and they're going to be looking to replace it. And retail just can't grasp the concept of credit risk very well.
Wow. Hey, Mike, worldwide debt from governments, I think, went up 7.5 trillion in just a quarter. 3.5 trillion of that was from emerging markets. 2 trillion was from China. Moody's said 40% of this debt is supposed to mature by 2028. So, is it possible they're going to have a credit crunch, or that China will have to devalue its currency because their rates are below Japan? This is a lot of debt out there, so I'm just curious if they're going to be able to roll it successfully.
Well, it's certainly going to be tested. Just as the equity markets are at all-time high, debt levels are at all-time high. But it is a bit of an emperor's clothing situation where everyone is more leveraged than they ever been. All the countries, they virtually doubled before and after COVID. And everyone is hesitant to cast stones at even the weakest countries because no one wants to start a sovereign debt crisis. So the central banks, if there's a tough auction, the central banks come in and mop up the bonds they can't get done. It is tenuous. We are in untested grounds at these debt levels.
Yeah, I should add that as we talk today, the big news is gold just hit a record high because the customs wants to put the 39% tariff on the Swiss gold bars. So we're trying to figure out if New York's going to be able to be the leading futures exchange for gold, because they have to settle all this stuff. So it's getting to be interesting. I think didn't the central banks load up on gold just to kind of help shore up their balance sheets for a while?
They have been big buyers because I think it was 3 years ago, they declared gold to be a class 1 asset for their equity tests. So, it became, I think they're more comfortable. I think they're certainly more comfortable. Their other choice was to buy sovereign debt from other countries, which are now more leveraged than they've ever been. And so gold is, even though crypto was supposed to replace it as digital gold, on a regulatory basis, it's more attractive than it's ever been.
Yeah. So Mike, I'm an ex-banking regulator, and it's my opinion that Dodd-Frank is a disaster. I remember when Goldman bought Silicon Valley Bank's treasury portfolio on a Thursday, they would have been solvent on a Tuesday, but the mark-to-market accounting forced a fast sale of their assets. And when I was a banking regulator, we didn't have mark-to-market accounting. So a lot of people just didn't realize how volatile treasuries could be, especially the farther out you go. But right now, obviously, the rage on Wall Street is this private credit. It's a $3 trillion a year industry. It's 10% of our GDP, apparently. And the banks don't really like to lend to you now unless you have a perfect credit score. So if you're less than perfect, like say 798, they pass you off on these other institutions and start marking up your loans. And right now they're leveraging these loans to get an 11% yield. And these, just so everybody listening, you can go to a Morgan Stanley, Merrill Lynch, UBS, and they'll put you in these private credit deals. You have to wait for an opening. But is there any chance this implodes one day? Because last I saw, leveraged loans have a 7.2% default rate and might be headed a little higher.
Once again, uncharted waters. I think the buyers of these things look at the yield, and if Morgan Stanley's recommending it, they consider that a stamp of approval, despite the disclosure documents they may sign before they can buy them. I think the reason the regulators don't crack down is that it's removing credit risk from the banking system, which they like. And I'm pretty sure that the only people that can buy these things are technically accredited investors, which when they first designated that class, you had to have a what, $1 million of net worth and make 200,000 a year. Well, 25 years ago, that was pretty good numbers. Today, not really. So you really can't call these people sophisticated investors. I I I can almost guarantee you they don't look at the financial statements of anything that they buy. The problem with high yielding investments like this is they're easy to buy, they're not easy to sell. When they create exotic financial instruments, there's a big marketing push, and as the sales snowball, you hear your neighbor bought some and he's happy. It's like it's not exactly a Madoff situation, but it's similar in that until the music stops, nothing's wrong. These default rates, I bet you most of the people that own those 11% pieces, they don't know there's a 7.5% default rate underneath it.
Yeah, I would agree. Well, since you brought up Madoff, I'm down here in Palm Beach, Madoff Central here, former Madoff Central. You know, the big scandal here, other than Bernie, was in 2008, they were selling leveraged munis. I believe at that time you were at AIG, and of course they were able to sell leveraged munis through the AIG credit default swaps. But when those things failed, they were forced to unwind them all at once. And I remember a lot of my neighbors losing up to 97% of their money because when they went to sell the munis, it was basically the equivalent of like a stock market flash crash. They all had exit at the same time, and you know we had a flash crash in the market 10 years ago. I think August 24th, 2015, and that flash crash knocked the stocks down 35%. Well, actually, stock ETFs down about 35% for a few hours. In the day, a lot of them were unchanged, but it wasn't very pleasant. So, are there times in the bond market where you have these kind of sudden liquidation events and everybody just gets fleeced? Does that happen very often, or it hasn't happened since 2008?
The problem is we talked about the lack of liquidity and that there's really no market makers. You know, the tape of trades that have transpired is a little murky. The contagion risk in the bond market is that there are defaults, and when you go to sell something and they tell you, well, it's down 20 points because of the problem the company had, what happens is some people panic and they say, I'll sell at any level. And that just, they're not evaluating the situation. They just want out. And that's the first level. The second level is when those things happen, people go, well, I wonder what the rest of my stuff is worth. And they start testing companies that aren't in trouble at all. And when there's a rush to the door, the whole category starts going down. Like as we saw in the subprime mortgage situation, it started off slowly, and then everybody wanted out. And who's the brave person that steps into the breach? It's going to be a distressed shop, and they always lowball you. That's their specialty. So it's that lack of transparency and the inability to evaluate what it's probably worth, even in a restructure, that can cause a panic in the short term. A flash crash is it's only hidden because you don't. How many people do you suppose even know that leveraged bonds are down 7.5%? It's not a high profile category, but nobody knew about Madoff until the damage was already done.
Yeah. No, it's people have to realize markets are liquid, but they're liquid at a deep discount. I guess we should add that in our UITs that we did, you did so skillfully. Occasionally, we had to sell a bond if the rating fell, and it was written in the UIT charter. And every one of those bonds that we sold went a lot higher. Is that correct?
I mean, that's something that, in fact, did change is that, like, what happened in the subprime was at that time, they had tranched out with, even AAA pieces, AA pieces, and that wasn't that long ago, right? It was 15 years now. The guideline said you can't hold these ratings. And after that event, they said they changed them to the ratings test was a purchase only test. And in the UITs, we got it to be a purchase only test. So when the downgrades came, you weren't forced seller. And that is the worst thing possible, is when you create forced sellers, because then they're price insensitive and the market will prey upon you. So, in fact, when the U.S. got downgraded to AA from S&P, most of these mutual funds and these structured deals, they had to go in and say that they had to change it from AAA to AAA or securities issued by the U.S. government, because if they had to force sell U.S. bonds, if they went AA by everyone, which Moody's is kind of telegraphing, they want to take the AAA away, and Fitch and S&P are already AA. If you had forced sellers of U.S. bonds, it would be a disaster. But it's not going to happen because they changed the guidelines.
That's why we have Scott Bessent in charge.
The Bank of England just cut rates for the fifth time this year after a contentious 5-4 vote. How many more central bank rate cuts are you anticipating?
Well, the banks certainly have an incentive to support the economies. They speak to pushing back on inflation, but the political pressure to cut is very strong. We see it here in the U.S. I think more cuts are likely. And if we get a global slowdown, they could come very rapid.
So, Mike, I guess the latest thing to confuse investors is that we are conducting a foreign policy through tariffs. It really exploded with Brazil. We had a 10% tariff with Brazil, but now it's apparently 50%, except on orange juice and aircraft parts. But Trump wants Lula da Silva to stop prosecuting his predecessor, Mr. Bolsonaro. Lula da Silva doesn't feel like he's respected, and so our relationship with Brazil has now become very, very contentious. And then, of course, we just had the incident with India, where Trump said, hey, if you keep buying the Russian oil, we're going to slap big tariffs on you. And sure enough, he did. And not only did Prime Minister Modi and Trump have a contentious phone call, apparently, because the Pakistan army chief was in the White House for lunch, and Modi wasn't too happy with that. It's also apparently going to force Putin to meet with Trump, because it's putting pressure on Putin to do something, because I think India is the only one that can really buy all that Russian oil. It's heavy, it's sour, and they sell a lot of refined product afterwards. So these tariffs are getting to be more interesting than I thought they would be.
I agree. Once again, Unchartered Waters. I mean, I think it's going to be very challenging for many of the corporations to forecast sales and margins. And Trump's so mercurial. He's look how much he swung the market by announcing tariffs and then giving a 90-day delay, and then this is on, this is off. It's given all that kind of volatility, and as they say, it's been 100 years since tariffs were this high. And of course, last time it didn't end well. So it's for me, it's a little remarkable that stocks are at all-time high with all these untested things, the high debt levels, the tariffs, even kicking out all these immigrants is going to rock the boat here. I mean, there's so many things going on, but I do think that the goal is worthy, and I do think we'll see more investment. The strategy of getting people to increase manufacturing capacity in the United States, it appears to be working, but we all know it takes 2 or 3 years to build a factory.
Yeah.
We won't know if it worked until the end of Trump's term.
Yeah. Well, with Japan, South Korea, and Europe, I guess that was another $1.5 trillion of proposed onshoring. So we're over 10 trillion onshoring right now, and of course he got Apple onshore even more the other day. So it's going to be interesting. It's obviously a lot of this is automotive. So those 5 southern states are going to be booming that have most of the automotive business. And then obviously a lot of it's semiconductors, and Taiwan Semi and Arizona seems to be got the lead on that. The Intel thing's just a mess. The Intel plant in Ohio was canceled because the Defense Department reneged on buying chips from Intel. I remember, so I was in Ohio talking to people about it, and they were all excited, and then the Defense Department reneged, so Intel never built the plant, and of course Trump wants the Intel chief to resign. Then the other thing that's interesting is I guess he wants all the pharma to be onshore too. I mean, Lilly's obviously in the process of doing that, but our deficit with Switzerland, Ireland, and of course China, a lot of that's pharma. Those are the industries I think are coming back. Yeah, it's compound complex. Have you ever met Howard Lutnick? I know him because my son went to school with his kid at Stanford.
Never did.
Because Howard, this tariff fantasy is Howard's fantasy, and obviously Howard and Scott Bassett are giving Trump all the advice. They're the ones that broke it to him that the bond vigilantes were in charge, and when Treasury yields briefly went up, and that caused Trump to do the tweet on April 8th that to buy everything all in caps exclamation. So and Mike, I think Trump's in the money management business now. He has 4 different accounts through Yorktown Securities, and then he's filed for 2 crypto ETFs. So it's interesting just to watch it all unfold. Oh, and he's in our business too. The family, Laura Trump and Donald Jr. took a big interest in Salem Media. They popped the stock 272% that day. But Salem Media owns Eagle Publishing, which is the newsletter business like I'm in. So I just found that to be interesting. And so I keep bugging my friends at Salem what's going on, and the Eagle division. I haven't heard too much, but I've never seen somebody in government be so busy in business. so it's interesting.
It's certainly one of a kind, though. But you brought up a good example where Trump came out and said Apple should build iPhones sold in America. They should build them in America. And that's never going to happen because I think the estimates I've seen, it would raise the price of their best phone from $2,000 to $3,000. Not going to happen. But they, Tim Cook went to the White House, got him a nice little plaque to put on his desk, and pledged another $100 billion. So he's getting people to move in his direction, but he certainly rattles a big saber to get there.
Yeah, I know. Yeah, I guess the Gorilla Glass, which actually comes from where Crystal went to undergrad near Ithaca, Corning's there. But I guess they're going to make it in Kentucky for the phones and the watches. So, Mike, I think it's time to wrap soon. So let's talk about Jackson Hole. Obviously, this is a wonderful event. Leaders from all over the world come there for the Kansas City Fed Conference. So if you were there, who would you be hanging out with?
I think I would sit and chat with Austin Goolsbee only because I like the way he explains things. It's it's almost like a Mark Twain version of economics, and he's relatively new, so he doesn't have to be so defensive about mistakes made in the past. But yes, this year is going to be especially interesting, I think.
Yeah, because Powell's a lame duck. I don't care what Powell says. He's a lame duck. And we got inflation next week. We'll see if it comes in below economists' expectations. It has for the last 5 months, so it's going to be interesting. I think we're just importing a lot of that deflation from China. We'll see that mostly on the PPI, but we'll see. But I guarantee you the central bankers will be in a good mood. So that's that.
Well, perfect. Thank you so much, Mike, for being here and for joining us today. Thank you so much to you all for watching and supporting us. Make sure to like and subscribe if you haven't already. If you want to ask any questions, make sure to leave them in the comments below. All of Mike's links will also be in the description. But until then, we'll see you all for a new video. Thanks so much, everyone.